What if I told you that one of the biggest financial bubbles in history was based on nothing more than a grand illusion? Picture this. The year is 1720. The South Sea Company, a British joint stock company, paints a tantalizing vision. They promise to open up trade with the South American colonies, a land teeming with untapped riches and endless opportunities. This was a time when Britain was at war with Spain, making trade with Spanish colonies a distant dream. Yet the South Sea Company made a bold claim. They promised investors the moon, despite having no realistic means to deliver on their word. The company was essentially selling a dream, a grand illusion of wealth and prosperity. Yet who could resist such a promising venture? Investors, both seasoned and novice, were drawn in by the allure of quick riches. An empty promise, a grand illusion, and yet investors flocked to the company like moths to a flame. As shares in the South Sea Company soared, so did the dreams of its investors. This was the era of the South Sea Bubble, a period of rampant speculation and frenzied investing. The allure of unimaginable wealth painted by the company's clever marketing drew in investors from every stratum of society. The company's stock price began to climb. And not just climb, it skyrocketed, inflating the bubble larger and larger. This was despite the fact that the company had no real trading operations. The South Sea Company was essentially a mirage of wealth, a grand illusion that had captivated the public's imagination. And yet, investors continued to pour in their life savings, blinded by the glittering promise of an easy fortune. The stock price inflated at an alarming rate, fueled by the irrational exuberance of the investors. The bubble, now gigantic, seemed invincible. But as we know, what goes up must come down. In the summer of 1720, the illusion began to unravel. The South Sea Bubble, a grand spectacle of hope and prosperity, was on the brink of collapse. The South Sea Company, once the darling of Britain's financial world, had its dirty laundry aired for all to see. As the sweltering heat of summer set in, so too did the realization that the company's trading operations were nothing more than an elaborate facade. There were no ships sailing to the South Seas, no exotic goods filling the company's coffers. It was all smoke and mirrors, a house of cards teetering on the edge. The revelation was like a bolt of lightning, searing through the heart of the investment community. Panic spread like wildfire as investors scrambled to offload their shares, fearing the worst. But it was too late. The bubble had burst and the fallout was swift and severe. The stock market crash echoed through the streets of London, reverberating in the hearts of those who had staked their futures on the promise of South Sea riches. The once bustling Exchange Alley was now a scene of despair, a testament to the devastation left in the wake of the bubble's burst. The fallout was catastrophic. Fortunes were lost, lives were ruined, and the British economy was plunged into a deep recession. The South Sea Bubble had burst, leaving a trail of financial ruin that would be remembered for centuries to come. So what can we learn from the South Sea Bubble? Let's delve into the key lessons that this piece of financial history has left us with. Firstly, the importance of due diligence cannot be overstated. In the frenzy of the South Sea Bubble, many investors jumped in without understanding the company's business model or financial position. This lack of investigation left them vulnerable to the whims of market speculation and ultimately led to their downfall. Therefore, it is vital to scrutinize any investment opportunity thoroughly before making a commitment. Secondly, the South Sea Bubble showcased the dangers of speculation based on hype and rumor. Speculation can inflate the price of an asset beyond its intrinsic value, creating a bubble that is bound to burst sooner or later. It is essential to distinguish between a solid investment and a speculative gamble. Lastly, the South Sea Bubble was a consequence of unregulated financial markets. The South Sea Company was able to inflate its share price through misleading claims and insider trading, practices that are now illegal in many jurisdictions. This highlights the importance of robust financial regulation in maintaining market stability and protecting investors. The South Sea Bubble serves as a stark reminder that while the promise of quick riches can be seductive, it can also lead to financial ruin. Remember, if it sounds too good to be true, it probably is.